Welcome back to the KRON 4 Morning News. Dow's up 100 points right now. We're watching the markets with our financial expert, Rob Black, and oh my, Netflix. What a day yesterday. Pretty good quarterly report.
What a different 3 years it's been. 3 years ago, hot and sexy. And then we started realizing we didn't really like the content that they had, and they made a deal with Disney to get Disney's content. So we like the content they have. So the stock went from 200 to 55, back to 200 because of House of Cards. They added 2 million American subscribers, 1 million overseas. The numbers are good. Listening to their conference call, they weren't jumping up and down. They weren't selling it. They were just saying, okay, here's the numbers. They're opening up a new stream, so up to 4 members of a household could watch Netflix on different sets for a little bit more money, not that much more. But if you have children, Netflix is a godsend. They've got all the Disney programming, television and movies at this point in time. So they're really doing things right. They became HBO faster than HBO could become Netflix. That's the phrase that everyone keeps throwing out there. Wouldn't chase the stock up 40 points today, up 20%. But I would keep it on a watch list if things really get a heck of a handbasket in the U.S. economy.
Yeah, especially because now you're back to like 211 with the stock up like 30-something to $38 a share. That's like a $10 billion valuation. This isn't a $10 billion company, is it? Not now anyway, is it?
30 million Americans use it at $10 a month. Do the math, that's $300 million of cash per year. Again, they're growing internationally. They're going to have to add revenue streams. They're going to have to get rid of the DVD mail system. And they're probably going to be acquired by someone like Microsoft, someone like an Apple who wants content to get onto their devices in the future. If not partnered with, acquired.
Okay, so Netflix, we're around 30 cents a share for their earnings per share. And then Apple, the expectation today at the closing bells, they're going to be around $10 a share for earnings per share?
Let's just call it 7.
Okay.
Let's lower the number to where the stock's trading at. Let's pull it down and say what Apple has to do is say, we've got this makeup container that connects to the internet. We got a watch, we got a wallet, we got glasses, we got something that people are going to want. Long story short, Apple used to sensationalize and get the high-end first movers advantage of getting all the rakes of money of charging full price for something. And then HTC and Samsung, they do it okay. Pretty good. Some Samsung features are amazing. They can translate any language. The mapping service is a little bit better. So Apple just needs product, and people will respond with the share price moving higher.
And I'm laughing because your makeup container is Mac.
There you go.
Different kind of Mac, though. All right, we're watching earnings season overall, though.
Yeah.
You happy with what's coming out? I mean, most companies are doing pretty well as far as earnings growth. Not as well as last quarter, though.
Yeah, we know the second quarter is going to be the worst quarter, and surprisingly it is. So the way I would judge it is so far so good. We haven't fallen apart. Companies like Travelers, companies like Coach, companies like Netflix, they're all operating pretty darn well. Again, we're not expecting anything from Europe, so that's built into the cake, so to speak. China's slowing down a little bit more than we want to, so that could be maybe a shoot of fall down the road. All things considered, the housing numbers, housing prices up 7.1% through the first 2 months of the year. Demand for housing is high, supply of housing is low. That's helping keep our economy moving forward. Just a few years after they had their own recession in the housing market.
All right, thank you, Rob. We'll check back with Rob at 9:15 for today's winners and losers on Wall Street. Daria James.